everybody. Happy Friday. Let me get this because I'm going to join the live too so I can see the comments. Happy Friday. It is a short week, but doesn't mean you can't be productive, right? This is Finance Friday, where we teach you all about how to grow and protect your money. We try to transform your relationship with your money. I'm Amy Novakovich. This is James Novakovich. And we're going to go over today some quick tips on just getting along in the stock market. Even if you're not interested in investing, knowing some quick tips on how to invest in general is always good if and when you become ready. Or if you're just sitting around having conversation, it's always good to be able to participate. So we're going to give you some value today, some insight that hopefully can help you grow your money. I am completely fried. I was on an 1.5-hour phone call with a client.
You held it together pretty well.
I mean,
but I can tell you were ready to get off the phone about 45 minutes ago.
Sweet lady. Very, very nice, very kind lady. However, just where do I go? I don't see anything on my screen. It's like go to the browser, the line that you type. Well, when I write, it doesn't do anything. I'm like, no, you have to type it. Anyway, so I'm a little fried, so I'm going to kind of sit back. Hey, Johnny, I'm going to let you, what are some tips, honey?
So today, we're going to talk about tips on how to make money in the market. Which way? Oh, I got to go this way.
Yeah, it's the opposite.
We're not going to do this setup again.
Why?
Because
we have the lights, we got some new lights, we got like this new webcam, moving up in the world. Yeah. Microphones aren't working. I guess I can take this off.
Can't we ship this?
Which way?
That's better. That's much better.
Okay, it's fine.
All right.
Just leave it.
Okay.
It's fine.
All right, so some of the tips to make money in the market, because we've had people ask, you know, a lot of our Finance Fridays are very general and very basic.
Well, a lot of it is about business consulting, and then we also do tough stuff about just finance in general, how to save money or things like that. But we talked about the market too, but I don't feel like we've ever talked about giving you actual tips on how to invest in the market. So,
all right, so
we'll try to be basic.
Let's talk about, why don't you talk about what we do when we buy on the dips? What do I mean by saying we buy on the dips?
Well, when the market goes down more than 2%, so right now that's about roughly 500 points. Whenever the market goes down about 500 points, hey Stephanie, usually I'm going to interview her on a podcast. It'll be really
good.
Awesome and live.
I heard that.
We got to schedule that. Shoot me an email right now to schedule that. Anyway, so buy on the dips. When the market goes down more than 2%, so approximately 500 points, a lot of times it's just downward momentum. It's a lot of times computer trading. You know, a lot of the stop losses kick in, which we don't have to talk necessarily about stop losses. We can cover that if you want. But just know that it's computer trading. So we try to add value by going on and actually buying on the dip. So when the market goes down more than 2%, you better be betting your butt that we are buying, in general, the S&P 500. There's several ETFs or exchange-traded funds out there that are the general S&P 500. So we're not trying to stock pick when the market is going down to in hell in a handbasket. We're just trying to buy the general market. So we'll go out and buy the ETF when the market goes down more than 2%, and we will take 10% of existing cash. There's always cash in an investment account. So we'll take 10% of the cash and put that to work on a down day of more than 2%.
Good. And why do you do the 10%?
Why are you asking me questions? Why don't you just answer it? I've been on the phone talking for an 1.5 hours.
All right. Well, all right.
Go ahead.
So buying 10% of the available cash. We like to leave cash, whether there's 400,000 or 4,000 in cash, we would buy 10% of whatever's available in cash. And the reason we do that is because over the last, I think, 45 days, we've had 2 days of down 2%. So we've bought twice on those dips. And if you have available cash and you're always buying 10% on the dips, you'll always have...
I'm going to share the link. That's what I'm doing. I'm not being rude.
That's okay.
I'm sharing the finance.
Yeah, you'll always have some money that you can buy in the dip. Now, sometimes it might only be a couple $1,000s that you're buying, but at least you know on that day you're buying. But again, whether it's 400,000 or 4,000, we're buying on the dip.
Well, and I get asked all the time, by the way, how do you know if it's not a recession? How do you know if it's not the next 2008 when the market is going down 2%? Why do you, excuse me, why do you buy when the market is going down? Don't you, you sell, or how do you know it's not a recession? Why don't you address that real quick about?
I mean, I think everyone's scarred from 2008 because that was very traumatic. I mean,
Sure.
The financial markets almost went away. I mean,
Yeah.
It was that serious.
Right.
But we're through that, and right now the Fed just raised rates last week or 2 weeks ago. They're going to raise another 2 more times probably by the end of the year. If there's a recession coming, the Fed would not raise rates. So when the economy's doing well, the Fed raises rates to cool the economy down. And we don't have anything to worry about, at least this year and probably next year. I know there's some people out there talking that the Fed's being so aggressive that there could be problems.
Slow down.
Yeah, there could be problems in 2020. I don't know if I necessarily agree with that, but
well, we had a great jobs report today, so that's another quick tip that I will give you is that when you see news on jobs reports coming out, a lot of times the markets trade on these jobs reports. So if you do use stop losses, actually let's talk about stop losses for just a second. That's now the second time I brought it up. Those of you that don't know what a stop loss is, it's a way that you can set a specific price on when to sell your stock. So for instance, if your stock is way up from where you bought it and you have a lot of gains and you don't want to lose those gains, you can put in a stop loss at a specific price. Let's put an example. So if I bought it at 100 and it's now trading at 200, I have doubled my money, right? So I don't want to lose these gains. I don't want to just sit it and hang on to it and lose these gains. So I can put in a stop loss at 190, a 5% stop loss. If the stock goes down and hits the 190, it will sell. So now I just sold my stock at 190. I protected, remember I bought it at 100. I protected $90 per share in gains, which is awesome. Versus if the stock was in a free fall and you didn't have the stop loss, if the stock went back down to 100, you just erased. I'm trying to fix my hair here. I know you have.
You're always playing with your hair.
I know, you too.
Me too?
You are always playing with your hair.
Oh.
No, you don't play with my hair. If the stock was in a free fall and went back down to 100, you lost all your gains. The stop loss saved you and sold at 190. So a lot of times, go ahead.
Well, it triggered a market order at 190 and it would execute. So it's possible.
The next best price. I'm trying to keep it simple.
All right, keeping it simple.
You're getting pretty technical.
Okay, you're right.
But yeah, go ahead.
Well, it's possible that you put a market order or a stop loss at 190, and if it blows through 190, if say it's after hours and it blows through 190 and it opens the next day at 180, you're gonna sell at 180. So.
But that was kind of my point of when is it appropriate to put on stop losses, and in times of volatility around the jobs report, usually the market responds to the jobs report. So if we fear that the jobs report is going to be negative, it might be a good time for you. I don't know you, and I don't know you personally. This is not a recommendation, but it might be good for you to look into possibly putting a stop loss on in case the market tanks.
Yeah, if you don't have somebody watching your money. We don't use stop losses.
Well,
because we're watching.
Don't say we don't use them. I mean, we have used them. We've used 10% trailing. We've had clients that want them on.
Well, when we have clients that want them, but where we watch it close enough, where we don't need stop losses because we're watching it all day anyway. But for those of you who don't have advisors that watch, or if you do it yourself, it might be a good idea to put it on there, because if you're the type of person that owns stock but looks at it once when the statement comes in every month, you might want to use stop losses.
Right. So let's review real quick. So we're talking about quick tips on how to get around the ups and downs of the stock market, how to help you hopefully make money, lose less money in the stock market. And so far we've talked a little bit about buying on the dips when the market goes down more than 2%. Take some of your cash. You never met Pippa.
I love her name.
She's awesome. He would love you. So when the market goes down more than 2%, we do for our clients that know about this strategy, take 10% of cash available and buy the exchange traded fund, which is just an index of the S&P 500. So it's like SPY, for instance.
And the reason we do the SPY or any S&P 500 ETF is because you don't want to necessarily bet on a stock on a dip like that.
Yeah.
We'd rather just play the market because we know the market does this, but over time it's going to go up.
Right.
In this economy, we feel like it's going to go higher. So. And
then the second thing we talked about already is stop losses. Stop losses is a way that you can put in a specific price. I guess you could do a buy or a sell order, but we're specifically talking about selling your stock with a stop loss. You can put in a specific price that should your stock, when it's trading, hit that price, it would sell at the next best price. So, and that's called a stop loss. Hi, Samantha. So we've talked about buying on the dips and we've talked about stop losses. Next.
All right. So when you enter a position, you need to have a goal to when you're going to get out, or at least to trim the position.
What do you mean goal of when to get out? A specific price of when you're getting out?
A specific price. So if you're going to buy a stock at
target,
50, if you want to have a target of, say, 60, when it hits 60, we're going to sell a quarter of the position, or whatever that number is. We typically use, well, it depends on the position, but it's anywhere from 10 to 20%. We usually start trimming. A typical stock would be 15%. So if we enter a position at 50 and it runs up 15%, we will, and we still like the position, we still like the stock, but we're up 15%, most of the time we will sell 25% of the position just to lock it in.
And again, this can't be a recommendation because we don't know how you analyze your own stocks, and that can be a different Finance Friday. If you're not sure how to analyze stocks, you can give us a call. But that's not what we're talking about today. So we're just talking in general. If there's a stock that you own and it has run up, and in your example, if you bought it at 50 and it ran up to 57.50, which would be 15%, we would just take some off the table. Did you mention that? I wasn't paying attention.
Yeah.
That we would sell half or a quarter?
A quarter.
So we would just sell a quarter.
If we still like the position, we'll only sell a quarter.
The one thing I have to, that's what we do. But for you out there that may have your own account at, let's say, and we're not associated with any of these companies, but like a Fidelity or an E-Trade or a Scottrade, well, that's now TD Ameritrade, you're going to have trading fees. So keep in mind that if you have a smaller position, a smaller dollar value, let's say you have $1,000 in a stock, you don't want to pay a $10 trading fee, right, to trim a quarter and then trim a quarter and trim a quarter. So you might want to trim half to reduce your trading fees, right? That's another tip. You've got to keep in mind your trading fees have an impact on your performance. If you're trading your own account, you have to calculate, for instance, if you have a $10 trading fee and you sell $100 of something, that's a 10% fee. So you have to keep in mind your trading fees because it will knock into your performance.
Right. But if you look at the big picture of what we talked about so far, if we're trimming on the way up, and then when the market goes down, we're buying 10% of whatever's in cash in the overall market.
Yes.
I mean, everyone knows you buy low and you sell high, but so many people.
Easier said than done.
Yeah. So this is a good discipline. This is really why we do well with equities, is because we actually do that. You know, you almost have to.
Very hard to buy when the market is in turmoil. Your general response is when there is turmoil to run, to sell. Hey, Christopher, when your natural reaction is when the market goes down, I sell. Instead, it should be the opposite, unless it's a recession, which most of the time it's normal market volatility, right? So, for instance, in 2008, we got completely out of the market because Lehman Brothers, a AA rated institution, went under along with 5-6 other institutions. That's different. Right now, in an economy where they're raising interest rates and we're seeing unemployment below 4%, this is in a market where we're expanding in the economy. And so any big down days that you're seeing right now normally is just normal market volatility. So we're trying to add value by saying anytime the market goes down more than 2%, go ahead and put some of your cash to work. And you don't have to be a stock picker. That's another tip, is just buy the general S&P 500 by buying an ETF, an exchange traded fund. It's an easy way, like an SPY is the ticker of the iShare, I think. That's an easy one. again, I keep saying that these are not recommendations because we're just trying to give different tips because some will appeal to some investors and others will be for other investors. And the easiest way to get in the market is just to buy the market in the form of the ETF. I mean, you're buying the S&P 500. Yeah.
So how many people out there have done this? So you buy a stock and it goes down 10%. And then you're like, oh no.
Oh, sell.
And then right away it goes down another 10 or 15%. So now you're down 20 or 25%.
Ooh.
So that's uncomfortable, right?
That's uncomfortable.
So, and a lot of times what people will do is they...
Again, for those of you that just joined, my brain is fried. I just got off an hour and a half tech conversation with an 85-year-old woman. Bless her heart, I love her. I really do. She's a great woman. I just tested my patience a little bit. That's all. Sorry. So if I seem a little weird, I'm just
weird.
Fried.
You always seem
This is
weird.
not alcohol. This is tea.
So, in that example, though, market goes down 10%. You're uncomfortable, but you do nothing. It goes down another 10 or 15%. Now you're really uncomfortable, and maybe the news in the company changed and things got really bad. Most people will sit there because they don't want to realize the loss.
Like with Facebook was an example.
Well, that would be...
Or GE. I see where
GE,
you're going now.
yeah,
okay,
GE
I'm following
is
your
a
trend.
better...
GE.
Yes. Yeah, the story has changed with GE. They can't pay their dividend. It's a sinking ship. And it's so sad because they used to be the standard, and now they're...
In everybody's portfolio. I mean, we just had a client that told us that her husband got sick and didn't pay attention to his portfolio for a while, and GE was a huge staple, and he just thought everything was fine, so he didn't pay attention to it. And he lost a third of his value last year when the market was doing awesome. But because he wasn't really paying attention and didn't have somebody paying attention for him, and he had GE and didn't adjust it, I mean, it really affected his net worth. So you have to be on it, guys.
Yeah, you definitely have to be on it, and
if you're going to own individual stocks, especially.
Yeah, for... No, that doesn't look
You're
good.
putting your arm around me?
Yeah.
That's nice. Oh, he loves me.
Hand over your mouth. So you can't be afraid. This last tip is you can't be afraid to take the loss. I mean, sometimes you're just going to be wrong. If you still like the position, in this example, if it goes down 10%...
How do they know? Okay.
If they still like the position, if the company's good, if the earnings is good, and the market just goes down, you know, if it goes down 10%, I think usually when we still like a position and it happens to go down 10, we'll buy more.
Right.
But if it goes down another 10 or 15%, then
like
maybe there's a problem.
Went down. We bought more.
Well, they didn't go down 25%.
No, but they went down from 179 to 150.
Yeah. And we did buy more, and now it's at 198.
And I was on a Finance Friday telling everybody that we were buying.
But you can't be afraid to lock in a loss and just move on, because if you put in 10,000 and now it's worth 8, you know, you have to ask yourself, what's going to make more money? This position that could be sinking lower, or this other position that we feel is going to do better. I mean, it doesn't matter if you take a loss.
Your point is if it's something to do, if it's going down and the market isn't really going down, you have to take a deeper look.
Yeah, that's a bad sign. Yeah, if the market's going up and the position's going down.
If it's just a headline, like Facebook was just a headline, like, oh, they're getting sued, oh, they gave out some information, whatever. But GE, they have some major financial problems. They can't pay their dividend. I mean, it's some things major. It's not just a headline. It's the fundamentals within the company are breaking. So things like that you have to, when you're analyzing your equities, you have to dig through the dirt.
Yes.
To see why it's going down.
So those are some tips today. That we have more, but I think maybe we can do.
Well, this is good because it's already been 20 minutes. So just review real quick and then we'll wrap it up.
So we want to buy on the dips. Mm-hmm. We typically take 10% of whatever's in cash and buy the overall market, the S&P 500.
When it goes down more than 2%.
When it goes down more than 2%.
About 500 points.
500 points on the Dow. Have goals on when you want to trim your positions. Typically, we do like a 15%, anywhere from 10 to 15, depending on the kind of stock it is.
When the stock goes up, what he is saying, when the stock goes, you're getting into your lingo. When the stock goes up of 10 to 15%, we sell some. And I'm suggesting if you pay your own trading fees to possibly sell half and just take some gains off the table.
And if you don't have an advisor that watches, or if you do this yourself, you may want to consider stop losses. Just in the event that something goes down hard and fast, you'll at least get out at a price that's acceptable to you.
And if you missed what a stop loss is, go back in the video because we talked about what a stop loss was earlier.
All right. And then finally, it's not always the worst thing in the world to take a loss. Sometimes you're going to be wrong, and it's okay. Take the loss and move on. You know, you can't win them all.
Yeah.
So don't be afraid to take a loss.
That's tough.
It is.
It's a tough thing to do, especially when you're attached emotionally.
Yeah, that's maybe the best tip ever.
Disney stock.
Don't get attached to any
Parker,
stock.
happy birthday!
Stocks don't care about you, so don't care about the stock. Don't be emotionally attached to your stocks.
Yeah, set price targets ahead of time on the upside and the downside of when you might get out of individual stocks.
All right. Have a great weekend.
Good. Everybody have an awesome weekend. Congrats on the short week, and we will see you next week. Share this video if you found value or tag somebody. Thanks, guys.